Welcome back to your weekly real estate and economic market update for the week of November 17th, 2025. Today, we're breaking down the latest data, and this one is packed with big picture shifts, falling Fed cut odds, rising inventory, a softening buyer pool, and what looks like a significant transition phase for the central Ohio market. We'll look at national macroeconomic forces, local housing dynamics, buyer and seller behavior, mortgage rates, affordability, and what experts like Yun expect for 2026. If you're a buyer, seller, agent, or investor, this episode will help you understand what's really happening under the hood. Let's jump in. The headline this week is clear. Markets no longer believe a December Fed rate cut is likely. The odds of a Fed cut to the rate in December slid below 50%. With a 54% probability of no change and only 46% chance of a 25 basis point cut. Just a month ago, cut odds were over 90%, which tells you how dramatically sentiment has shifted. Why the change? Well, sticky core inflation that's sticking right at 3%. Labor market is cooling very gradually, not enough for the Fed to act aggressively. There's hawkish commentary coming from Fed officials, and they seem to be split. A government shutdown that delayed data releases, making the Fed cautious. This is the root of the higher for longer theme. Rates have dropped from their peaks, but the odds of deeper, faster cuts have faded. For real estate, this means that short-term affordability remains tight, and we may not see real relief until 2026. Looking at the stocks, they declined across the board. The Dow was down 0.47%, the S&P 1.44%, NASDAQ 2.66%. Risk-off sentiment grew as investors processed a more hawkish Fed stance and delayed data releases. The 10-year Treasury, it was slightly higher. The 10-year Treasury, which is the key benchmark for mortgage rates, traded in a tight range but ended slightly higher, moving from 4.06 to 4.16. And finishing the week at 4.147%. Even these modest increases keep mortgage rates pinned higher. Mortgage rates are holding in the mid-sixes. Daily mortgage rates showed slight upward movement, moving from 6.32 at the beginning of the week to 6.38 at the very end of the week, with a weekly average of 6.33%. At today's numbers, mid-sixes do not unlock the affordability that most buyers are waiting for. Rates below 6 would start shifting behavior very meaningfully. Leading indicators? Well, look at the mortgage applications rates. They've strengthened, and here's the interesting part. They're increasing even with the mid-6 interest rates. Demand is firing up beneath the surface. Purchase applications, they rose 5.8% week over week, and that accounts for a 29.6% year-over-year rise. We've had 4 straight weeks of rising applications. They show buyers are waiting. They're not disappearing. If you look online and at social media, the commentary there reveals a sharp contrast in buyer psychology. Nationally, the themes are more inventory. It should equal a buyer's market in theory. True, it should, but with rates near 6.2 to 6.35%, they're keeping payments high, which is more of a non-buyer's market. In practice, so younger buyers, they're feeling priced out due to stale wages and rising prices. Many say renting still makes more sense, and this explains why showings are down, even though listings are up. Buyers feel the payment, not the price. Now looking locally over at Central Ohio, we're entering a rebalancing phase. This is the biggest local shift we've seen in years. Look at our inventory. It's up 83.1% year over year. Active listings, right now we're sitting at 5,926 of them. That's a lot of homes currently on the market when you look at how many were there last year. It's a monumental swing from the 2020 to 2023 ultra-low inventory. New listings are up 26.6% year over year. People are listing homes again. Some people are relocating, some are unlocking life changes, and some are finally willing to move at 6% plus rates and give up those low interest rates they have. Showings, however, well, they're down. They're down 45.5% year over year. And this metric tells the real story. More listings with fewer showings, buyers have the leverage. Affordability is improving. Franklin County's affordability index, look at the last 4 weeks, we went from 105.1 and we're right at 101 right now. It's up 17% year over year. Affordability is improving despite mid-6 interest rates. And it's improving because income is up, prices are stabilizing, inventory is rising. To hit exactly 100 on the index, rates would need to fall here in Central Ohio to 5.8%. We're close, but we're not quite there. The sales pace seems to be softening. Closings, we had 2,184, which is down 0.7 year over year. Days on the market, we're sitting at 34 days, which is up 25.9%. Months of supply, we're at 2.7 months, which is up 85% year over year. This is no longer a hyper-competitive seller's market. This is a choosy buyer, flexible seller market. Price is still up slightly. The median price is $335,000, which is up 1.6% year over year. Year-to-date price, $338,000, which is up 3% year over year. Prices are not falling, but they are flattening. That's typical during a shift from low inventory to normal inventory. Local sentiment matches the data. Columbus is framed as a major growth market, and Marion County is being called an undervalued play. Others say high prices plus slow wage growth make buying hard. Investors are warning that the easy money phase, it's over here. A quote from one report, more listings, but buyers still feel locked out of payments. That sounds about right. This nails the psychology of today's buyers. NAR's chief economist, Lawrence Yun, sees a strong 2026 recovery. He forecasts that home sales will be plus 14% year over year. Home prices are going to go up about 4% nationally. Interest rates he sees slowly improving, but not returning to the pandemic lows. He's guessing a rate cut, maybe one in December, and 2 more throughout 2026 for 3 cuts total. This prediction relies upon continued job gains, gradual inflation release. The government has reopened and data is flowing again. Inventory is still structurally low nationwide. This matches long-term fundamentals. The U.S. is still short 4 to 6 million homes nationally. Even moderate rate relief unlocks enormous pent-up demand. Buyers out there, take advantage of soft showing activity. With showings down 45%, you have the bargaining power. Use seller concessions strategically. Many sellers will buy down your rate. And don't wait for the 5% rates. When rates fall, buyers are going to flood back, inventory is going to tighten, and price growth is going to accelerate. If you find the right home now, date the rate. Sellers out there, price with precision. Sellers can't overprice in a market where inventory is up 83%. Expect longer time on the market. Average days on market is 34 and rising. Make your home stand out. Do the prep, the repairs, the staging. These all matter again. If you're an investor out there, more inventory equals more opportunities. The best deals come during uncertainty. Underwrite conservatively. Don't assume rapid rent growth or cheap financing. Focus on strong submarkets. Columbus continues to be highlighted as a top growth region. That wraps up your local market update for November 17th, 2025. The big theme this week is clear: higher for longer. Rates aren't collapsing anytime soon. Inventory is expanding. Buyers are selective. And the market is shifting towards balance for the first time in years. I'm James Dahl with Red One Realty, helping you on your path to home ownership. Thanks for watching, and I'll see you in next week's update.